Hello, this is Jed Brewer with Study Groups in the Below the Line Club. Very nice to have you on our webinar today. We are going to be talking about planning ahead for 2024. It's late September, but it's never too early to start planning ahead. That way we don't all get hit with the end of the year rush. But two kind of things that we're going to be talking about today is retail fuel profit margins and also choosing the right back office software. So there's some seasonality and timing, as we all know, within the retail fuel business, and really pleased to have David Thompson, who's the Executive Vice President at POWERHOUSE, who will be talking a little bit about some trends that tend to take place each year and what we can do to be ahead of those trends as we move into some of the seasonality in front of us to ultimately make sure we protect our profit margins in the best way possible. POWERHOUSE is a firm that works with fuel hedging throughout our industry and with several study group members. And secondly, we're going to be talking with Mark Lotstein, who's president of ROG Consulting, and he's going to be talking a little bit about what some of our choices are that we have for back office software, which is it's one of those urgent but not emergent kind of things that in terms of software often gets pushed to the rainy day fund or whatever, but sometimes we feel like we don't have a lot of choices, and what's out there is PDI has consolidated the industry. So Mark will be highlighting some of the options that we do have available for us as we all try to plan ahead and make sure our companies are running as efficiently as possible. So it should be a good webinar. We'll be here for 60 minutes. We'll start first with David and then move into Mark. We want this to be as educational as possible for you. So if you do have any questions, I'm going to have you on mute, but please type those into the GoToWebinar dialog box on your computer. I'll be able to read those questions and I can relay them to our presenters at the appropriate time. We will make the slides available to you after this call, as well as this is being recorded, and we'll make the recording available to you if you wanted to watch it again or share it with a friend. But again, this is about you and trying to get good educational content to you. So please do speak up with questions so we can get those answered along the way. So with that preamble, David, let's turn it over to you at POWERHOUSE to talk a little bit about our fuel profit margins and what can we do if we see changes in wholesale prices.
Thanks so much, Jed, and thank you all for attending. It's always a privilege to speak with study groups teams. As Jed said, we work with a number of groups around the country where we present, and we have several study groups members as clients, and we always appreciate working with study groups because it's companies that want to learn and grow and improve. And that's really what we like to do when we're working with clients, is help them protect their profit margins and grow their business. And I'd like to talk with you today about a few things that are coming up that we're looking at with our gasoline retailer clients, and to some degree also the wholesalers. But let's get into it. What I want to talk about is how you can try to protect yourself from a gross revenue squeeze or profit margin squeeze that tends to reoccur seasonally. And I mentioned to Jed before we started, this is really good timing because we're right about the cusp of when we start putting on protection for gasoline retailers to protect against what is a very typical seasonal squeeze that occurs in the first quarter and into the second quarter. And let's talk about, what we're really trying to dissect here. And what we're trying to deal with is the problem, as Jed said, when wholesale gasoline prices rise, retail prices tend to suffer. This came out from Opus's Retail Fuel Watch last month, and actually been preceded by the month before by a similar headline. And really what hurts gasoline marketers is when the wholesale price spikes very quickly. And there's just an inability to keep passing on that rapid rise in the price you're paying at the terminal. As you well know, as a retailer, your profit margin is the difference between that price you're paying at the terminal and what you can get on the street. And there's a very seasonal pattern to why these squeezes occur. What happens is the retail profit margin, you get stuck with this dilemma. Either you can lose margin by lowering your price or holding your price steady, and watching that wholesale price creep up and up and up, and sometimes it's not a creep, or you can hold your margins and your price, raise your price, and eventually start losing some volume, which may also in the end come out to the same thing. It's a loss of gross revenue. The spring margin squeeze, which we're most worried about for gasoline, is driven by a very clear cyclical seasonal pattern, which is gasoline demand starts to rise in the spring as we're coming out of winter. And at that moment, most refineries are attempting to do maintenance so they can get ahead of gasoline season. And it comes in right in that period, anywhere from, sometimes as early as January in through the peak of it, usually hitting sometimes right before Memorial Day. It can last a little bit longer, a little bit shorter, depending on how the refinery seasonal schedule works. But that's what drives it. We work a lot of customers and say, yeah, I'm competing against the guy across the intersection. What you're really competing with is the refiner. This is a slide that we always talk with our clients about, and it's really what I would imagine is very typical of the seasonal profit picture of a gasoline retailer. I just finished doing an analysis like this for a customer that has over 500 stations across 4 states, and their profit margins follow this basic pattern. Decent in the late fall, the best times in the late fall, early winter, and then just plunging as you move through early spring, bottoming out sometime usually around Memorial Day or into June, and then sort of improving throughout the rest of the fall. What we do with our clients is we map out their data and see how close we come to this pattern, and it's really, with very few exceptions, maybe some clients in resort states that have a different seasonal pattern with their demand when the tourists show up. It's usually very close to this. And the reason that I say this with such certainty is because it's driven by this. This is a slide Goldman Sachs produces, and it tracks the global refinery maintenance cycle. Bunch of years, all overlap, really tracing out the same pattern. They actually already have their predictions in, and they have a very dark blue line in there for the beginning part of the year. And you ask, well, how does Goldman Sachs know what refiners are planning to do? Well, they're big publicly traded companies, and they make announcements well in advance of the dates and times they're going to be taking their refineries down for maintenance. So this can be mapped and charted very dynamically and very accurately. And what happens, obviously, as you can figure out, is when the refineries are down, then supply at the terminals gets tight, driving up the price. So that's what drives these 2 spikes that tend to really hammer retailers. You're doing well, as you can see, in that period of December, January, even little bits of February, when refineries are running at decent levels. But it's when those refineries go offline, and the scale on the left-hand side is in millions of barrels a day of refining capacity offline. Then product gets tight, and that's when the squeeze hits you. The one that we are planning for right now is that part on the left. If you think of it as I think camel is the one with 2 humps. The first hump of the camel in April is the one we're getting ready to plan for right now, the spring margin squeeze. It primarily affects gasoline because we're heading into gasoline season. The second peak tends to affect diesel margins a little bit more. So what we're talking about, and what we are going to talk about, is hedging. We're not talking about speculating. We're not talking about putting on a position to try and make money. What we're trying to do is create a financial position to offset an expected business risk. We're trying to avoid the risk of adverse price movements hurting your bottom line. We're trying to defend against price volatility by setting up protection ahead of time. The good news about the strategy I'm going to present to you is that it has the benefit of giving you a defined amount of protection if a bad event occurs, namely wholesale prices rising, and it has the benefit to define the cost up front. So you know what you're going to pay, you won't have to pay anything more than that, and if the risk does not occur, if that seasonal pattern does not hold for some reason, could it be a geopolitical event or a political, an economic event, something of that nature, then you still have the ability to do well if wholesale prices fall apart. market, which tends to be better for retailers. So we really think it tries to give you the best of both worlds, and most importantly, you know the extent of what it will cost going in ahead of time. So let's dig into it.
So David, I can still win to the upside, but I can fix my downside exposure for a fixed price.
Correct. You're going to know ahead of time what your upside protection you're buying is, and there won't be a margin call or an expense coming in halfway through your hedge position, which we found most gasoline retailers need to have.
And David, you were talking about those two humps on the camel, and the first one is what's going to happen in first or second quarter of 2024 is being the thing that we are going to act on today in order to protect against. Why today? Why so far out of that first hump?
Well, what we're trying to do is take advantage of when we have enough time ahead of us to get positions situated, and typically we're trying to buy protection against upside moves in prices before that move occurs. If we wait too long and we wait until the spring, the damage may already be done. You can argue prices are already high. One of the basic tenets of all dealings in commodity markets is there is no price that is too high or too low. So even though we've had some strength in both diesel and gasoline markets, once refineries start going offline come spring, I suspect that will only add more bullish pressure to the market price. So we need to look now before those turnarounds start, or it'll be too late.
That makes sense. Thanks, David.
No problem. I'm going to do a quick little definition of what we're talking about. We're talking about using options on futures contracts. These are financial instruments. Some of you may hedge and know what these terms are. An option on a futures contract is the right, but very importantly, not the obligation to buy or sell an underlying futures contract at a determined price on a particular date. The hedging instruments were trying to produce offsetting gains in the face of adverse real-world damage from price movements at the pump. And the nice thing is, as I said, we know what your cost is ahead of time. I'm going to go through some terms. Option terms refer to months, like futures months or contract months, and the strike price refers to your protection level. And there's two types of options, call options and put options. We're going to be talking about call options today, which protect you against higher prices. Options on futures can really be thought of as akin to or an analogy of an insurance idea. Very similar, an option buyer, think of that as the policyholder. They pay a premium and they receive the right to reimbursement if that risk occurs. The option seller is like the insurance company. They get the premium, but they take on the obligation to pay out if the risk occurs. As I said, call options gain in value when prices go up, and put options gain in value if prices go down. We're going to be talking about call options because we're concerned about wholesale price of gasoline going up. Here's just a little basic for those of you who don't have a lot of exposure to options. Let's say, as I said, each option has a month that it protects and at a strike level and a type, as I mentioned in that last slide. So let's say you have a call option to protect you against higher gasoline prices in the month of May, and specifically at prices above $2.60. If the market moves to $3.10, then you have an insurable event. The market has moved higher and you need the coverage. At $2.60, then you're what we call at the money, meaning it's no payout because you didn't have an accident. And anything obviously below, that's a good thing. An accident didn't happen and you did buy insurance, but it turns out you didn't need it. I'm going to do two quick scenarios so you get an idea of how things move. Let's say it's September 26th, yesterday, and price of gasoline in your market is $2.50. And the May RBOB futures are $2.60 per gallon. And you're going to need to buy gasoline in May. This we know. You say, well, I'm worried about higher prices come May when all those refineries are in turnaround. So I want to buy a call option to protect me against prices going higher than $2.60 a gallon. You'd have to spend about 25 cents a gallon for that option. Let's say we get up into the month of April, we're almost up to May, and yes, in fact, refineries have had a lot of problems restarting. Several of the big ones down on the Gulf Coast have had issues. and gasoline prices have shot up 75 cents a gallon. Your local price is $3.25 and the NYMEX is trading at $3.35. In this case, your 260 call option, remember that's the option to be reimbursed above 260, well, that's worth 75 cents a gallon to you. So the quick math at the bottom, you're 75 cents worse in the cash market that you're buying now 5 months out, 6 months out, and you have a net of 50 cents coming in to offset that damage. So you had to pay the 25 cents premium, so that's why you're not fully hedged, but you do get a significant offset. And you knew all you had to pay was the 25 cents up front. Let's walk through what happens if the other side falls, and this is where options really shine. Because now this is how Jed was saying, you're getting to see the benefit on both sides. Let's say it's the exact same setup. It's $2.50 a gallon and the May futures are $2.60. You again buy that $2.60 call option and spend 25 cents for it. But let's say in the meantime, the Chinese real estate collapses and we're looking at global recession and gasoline prices fall by 75 cents. Well, your option to buy it to have protection above 260 is worthless because that is not the case now. But you're now buying in a 75 cent a gallon better environment than we thought in September, and you're only out the premium you paid. So you do get to participate with prices moving lower, just minus the cost of the option premium. So that's the real brilliance of options is you're protected where you need it, and you can do better if prices move lower in the case of owning a call option. However, as you've probably been thinking yourself when I've been talking, well, 25 cents, that's great that it costs that much, but David, that's my entire margin goal for the month. So that doesn't really work for me. We know that. We work with retailers around the country, and we are well aware of the patterns of retail profit margins. So what we said is let's develop a strategy that gives you a very decent amount of protection, but doesn't cost anywhere close to 25 cents a gallon. So that's where we come with this concept of a call spread, meaning we're buying a call and selling a call in the same month. So we're buying a band of protection, and that dramatically cuts down the cost. If you're a fancy finance person, or you maybe have done stuff in your stock accounts, what this is really called is a bullish call spread or a bull call spread. You're buying one option and you're in essence turning off your protection at a higher level. The reason this works for gasoline retailers is you need a certain amount of protection. You're not hedging a pipeline shipment where you need as much protection as the market moves against you. If we could say, hey, if I could get a net of 20 cents protection out of an option strategy for a known cost of 10 cents up front, 20 cents would do a lot of help for my margins in a particular month, and I could look where I can slice out some money to pay for that. So the big takeaway on a call spread is it defines your profit potential, so it's not unlimited, but you don't need unlimited, and it also costs a lot less. Let's do this example, the same thing as I started out with before in those earlier examples, where we saw that if I wanted to buy the May 260 call on RBOB futures, I had to pay 25 cents for it. But if I simultaneously sold the May RBOB 290 call, it's a different option. So what I'm really doing is I'm creating a 30-cent band of protection. I'm reimbursed above 260, and then once I get up to 290, those two options start to cancel each other out. The great thing about this is you receive a lot of money for selling that 290 call option. You're not naked, you're not selling a naked option. You own the better call, the lower call, the 260 call. So that cuts your cost down by 15 cents a gallon. So now we're only spending 10 cents to get a gross amount of protection of 30 cents. In other words, your net maximum profit on it would be 20 cents a gallon, and you're only spending 10 cents upfront for that. That we found works pretty well for a lot of gasoline retailers in that, 20 cents is a pretty big help to margin, and 10 cents is usually something they can find a way to slice out of some of their good profit months. This is the roadmap. We work with a lot of clients where we go through their business and we try and help them assess where their weak months are. I call it their roadmap, where we look at their combination of volume and margin. And here the client said, I'm going to give you my retail margins by month for the last 3 years, and I'll give you my volumes by month for the last 3 years. So what we calculated is, okay, what's your average margin for the entire year? And then we compare each month to that yearly average to determine where are your weak months. So was not at all unexpected. This client, their weak months happened in that first and second quarter. Specifically that February, March, April, May period, they really are suffering in terms of what they're pulling in versus their yearly average. And similarly, it trends over to their gross revenue because they're losing some volume in some cases. They're not their high volume months to start with, and now they're not even making that much on it. So it's tough to get ahead in those months. This helps us determine how much to hedge and also when to hedge. And it's a key component. When we work with clients, it's not a black box. We don't just say, here, do this and do that much. It has to be done where we assess your business and we try and help you build your own roadmap to know where your weak spots are. And that's really the fun part of digging into this is seeing exactly what your business looks like, and it helps you perhaps look at it in a new light. In the end, the real goal of what we're trying to do, as I mentioned, is going back to this first chart, which is your typical retailer profit margin pattern. What I'm trying to suggest to you is, hey, can you slice out some revenues out of your good months, the part in red over on the right-hand side? Not all of it. I just want to take a little trim as much as I can to use to get some funds to buy the insurance for the pothole that tends to occur in that February, March, April, May period. So we're trying to smooth out margins which we know have a typical seasonal pattern. And the best part of it is, if for some reason we're wrong, and we've had the global pandemic and we've had a war involving one of the largest energy producers in the world. So don't tell me wacky things can't happen. We all have lived through them. So the great thing is, Jed was saying again, is that if it turns out you don't have a bad spring, you're not foregoing all of the potential benefits. You have to pay your premium, you've paid that up front, but you can still do better if wholesale prices collapse unexpectedly during the spring. So you're not sacrificing the ability to do better. What you're doing is you're spending premium, a defined amount up front that you'll know before you start. You can scale it to be as effective as you need to. And we're trying to smooth out that lump that occurs in that first part of the year. So that's basically the idea. We're trying to do a risk-controlled way to address a typical seasonal pattern that shows up. And we've found that that's very helpful to clients because we're trying to take uncertainty out of their business, and this is one way to look at things. If you're interested in learning more about this, we have a special for study group members. We do a hedging class where we walk through this in a little bit more than 30 minutes. We spend the better part of 2 days going everything, and the next one is coming up in Austin, Texas in November. And as a study group member, you get 10% off your registration if you sign up. So if you're interested in more, there's the information for that. And you can, of course, feel free to circle back to Jed or myself if you need any more information on things. But with that, I'd be happy to take any questions and see if I can offer any advice.
David, thank you. One question, that 10 cents that you talked about, sort of the cost of the premium, does that vary over time? And if so, is that roughly what it is today?
That's roughly what it is today. Those examples were actual quotes I pulled for a few days ago when I was finishing up the presentation. It tends to be roughly in that 10 or 11 cent a gallon range if you're talking about right now and putting on the hedge position right now. If you wait and you're closer to the months that we typically see risk in, then it decreases a little bit because you're not asking the person on the other side, the entity on the other side of the transaction, to hold themselves out for that long. And remember, these are options that are traded on exchange, so we don't know who the counterparty is. We don't care. The exchange is really the counterparty. So it's not like we're going to an insurance company for this. So premiums can go sometimes a little bit down if you wait longer, but of course then the market overall price may have moved. So 10 cents tends to be about steady for this type of strategy for that amount of protection. If you want less protection, then it doesn't cost as much. If you want more protection, then it costs a little bit.
That makes sense. And the strategy we're kind of talking about is 4 to 6 months out in the future. Do you have to put money out today in order to buy that? And how much? Is it just that 10 cents per gallon, or tell me what kind of collateral is needed?
Correct. That if you wanted to do it now, you do have to pay up front for the option. So it would be 10 cents a gallon times how many ever gallons per month you wish to protect. The nice thing is that's the extent of the cash outlay. You're not subject to margin calls between now and 6 months from now. And you simply have, just like any type of insurance you buy on a vehicle, you pay and you have that coverage for the time period. The wonderful thing about this is, unlike a vehicle insurance where they make you buy it for the entire year, remember, I don't usually recommend hedging fully when you're expected to have good margins. You may always want to have some percentage on, but you can pick and choose your worst points of the year, which is very, very nice because it allows us to keep the cost as low as possible and try and look at your seasonal patterns and fill in the protection for what we anticipate seasonally or your worst months.
That makes sense. And David, what's the typical percentage of one's volume that they typically hedge?
That's a good question.
Fluctuate at different points in the year.
It certainly does. We have clients some clients hedge all year long, but they vary the volumes significantly, where in their good months, they may only hedge 5% of their volume. And in their heavy months where they expect to be hurt the most, maybe they're hedging 40 to 50%. I would say probably nobody, and this is coming as a broker who likes to do business, no, most people don't hedge 100%. If you're shipping on a pipeline, then yes, you need to hedge 100% of that. But this is sort of a thing that works into your business that you tend to look at how I develop my comfort level with it. When people start out, I always recommend do it with a pilot program. Do it an amount that the cost is not the thing that's making the decision. You want to run this and have it track against your business and see if it performs as we expect it to. So I would say it varies, but again, people do scale it seasonally, and as they get comfortable with it and it tracks for their business, they tend to do more.
That makes sense. Well, David, thank you so much for your time here and sharing the strategy and just some hedging tips and tricks with us. And we'll send out David's contact information. So if you have any follow-up questions, we welcome you to reach out directly to him. Let's turn now over to Mark Lotstein with ROG Consulting. And Mark's going to talk a little bit about back office software and what are the choices that we have out there, and also how do we get the most out of whatever current back office software system we have, those processes and those procedures that are going to make utilization the most powerful and beneficial for us. So, Mark, with that brief introduction, please take it away.
Good afternoon, folks. Has everyone able to hear me okay, Jed?
Yeah, you sound okay.
Great. I'm going to apologize in advance. I'm dealing with a pretty good cold, so I will try to keep the coughing to a minimum. Excuse me, as Jed said, my name is Mark Lotstein. I'm the owner of ROG Consulting. We've been in business for 16 years now, and let's see if I can make this slideshow work. Here we go. We work with retailers, wholesalers, transport companies, all aspects of the petroleum sector throughout the entire country. My team is made up of a wide array of experience and background, CFOs, heads of IT, former owners of chains, inventory companies, etc. We've worked with study group members, I think, Jed, I don't know, at least 10, 12 years now that we've been participating, and I listed a couple of the more recent members that we've worked with here on this slide. With me here, I'm sorry. What I want to talk about this afternoon is not just that there are options out there, and obviously, as everyone who's on this call is aware, PDI has made quite a number of acquisitions and continues to make acquisitions, narrowing the field of opportunities. But that doesn't mean that they've acquired every company that's out there. There are options, and I want to address that. The other thing that I want to talk about is process and procedure, and utilization of your software. And the first talking point is going to be process and procedure. You can have the world's greatest software, but if you're not fully implemented, if your staff isn't trained how to use it effectively, if they're not using the proper processes and procedures, you're never going to get that full return on your investment. And my number one question that I always ask a prospect or a client is, why are you doing it this way? And my two least favorite answers, we've always done it this way, or this is how I was told to do it. And I'm going to guess that somewhere between 80 and 90% of the time, that's the answer we get from folks. My big talking point to that is, folks, you don't know what you don't know. And that is, we need to look at our process and procedures regardless of our software to understand, does this work with my software? Does it not work with my software? Is there any value that it's bringing to the table in any way, shape, or form? Many times we go in to see clients and find out that they're doing processes and procedures that are double checking their back office software, and it hasn't shown with a problem or a discrepancy in multiple years, but they do it just in case or because this is what they've always done. What everyone needs to be thinking about, again, regardless of software, whether it's better utilization or a new software, is what are those processes and procedures that are in place today? Do they still make sense? Is there a value to them? Am I getting actionable information out of this? Or do I just have people pushing paper around, touching paper, looking at stuff that ends up in the garbage can? We also want to look at what's being done today manually versus automated. Is there things that can be streamlined that can be moved into the automation area?
I'll say on that manual versus automated, I find it interesting in conversations at study group meetings where people will spend all this money, hundreds of thousands of dollars on a new system, and then de-automate the best automation that they bought day one.
I was on a call earlier today with a client of ours, and they have a software and it has the exact functionality they're looking for, yet for a yet to be determined reason, they are doing the process manually. They showed me copies of the Excel spreadsheets that they're using. We discussed the amount of time and effort that goes into them, how many people are touching them. And then when we went back and we looked at the software itself and said, okay, so if we did this and this and this in the software, and it was over the phone, so I couldn't quite see the epiphany in their eyes, but I certainly heard it in their voices. Yeah, this would do exactly what we need in about 10% of the time. So it's a regular occurrence, and it's not a negative to any of the companies or any of the people. It goes back to the you don't know what you don't know. And more often than not, a lot of the folks who are working for you weren't there when the software was set up. They weren't trained by the software company. There have been new modules and upgrades to the software that you may or may not have taken advantage of. So again, there's a lot of reasons why things might be being done in a manual process, and they don't need to be. Excuse me. Again, getting the most out of your existing software, and I just mentioned some of these points, and again, I apologize. I am definitely under the weather. The implementation. In many cases, implementations take an extended period of time, 12, 18, 24 months or longer. During that time, there could be internal turnover of the company. There could be purchases and acquisitions or sales of parts of the company. There could be other focuses and needs that come up. Rarely is an implementation done to the 100% level. Many, many times I find people somewhere around 75 or 80% have just had enough and accept that level of implementation. They got the big ones done, but they didn't get everything they needed, and rarely do they ever circle back and get the rest of the value out of that software. So that's one area to look at. As I also mentioned, the training. I think everyone who's on this call remembers the old game telephone. As you tell somebody a story down the line, what started as a very coherent story on one side has become a completely different story at the end of the line. Same thing happens with training. If someone was trained how to use the software 12 years ago, and then they trained their successor, who trained their successor, who trained their successor, And that's if we're lucky. That's if the person didn't leave and someone else had to try to train them. There's a huge degradation in the level of training and knowledge. Upgrades and new versions of software. Many times I have clients and folks say to me, oh, the last time we upgraded the software, it was a huge fiasco. Don't really want to go through that again, or there weren't enough changes in it to make it worthwhile for us. Okay, well, maybe there was an upgrade that didn't have things that were really of value to you, but the 2 or 3 upgrades since then very well could be answering issues and problems that you're having, things that you're doing manually, things you can't do in the software at this point that now could be done. So taking a look and making sure, are you using the most up-to-date version of the software? Are there different modules of the software that are now pertinent to you? Again, has the business changed? Maybe you acquired another company. Maybe you've grown the lube business and really need to get more involved in the warehouse side of things. Making sure, speaking with your software vendor, speaking with folks in the study group who use that software to find out, are there aspects of it that you're just not taking advantage of today?
And Mark, you may have been the one who told me some time ago, but it kind of is the best practice to sit down with your software vendor once a year or so, talk about how your business has changed and how you're using the software, and they may have some tips and tricks on how you can better use their technology, and most vendors are very happy to do that.
Yeah, that was a conversation we had. Thank you for reminding me, Jed. Yeah, I mean, obviously, at the end of the day, the software companies want to sell you more software, want you to better utilize what they have. So yeah, there might be, you want to take certain things with a grain of salt, but it's always helpful to speak to them to find out what the latest and greatest is. And you know, PDI sends out a ton of emails. They just had their users conference in Denver a few weeks ago. But sometimes it's just too much information, and sometimes just having a sit down one-on-one, whether it's in person or over the phone with the sales consultant, can be a great help. Options. I seem to hear more and more people say, well, there are no options. PDI bought everybody. Well, yes, PDI bought a lot of people. That goes without saying. But they didn't buy everybody. There are software options out there, and there's different ways to look at this. In some cases, and sometimes we prefer one software to fit all aspects of a business. There are upsides to that, you know, no pointing of fingers, fully integrated sometimes, and more. And other times it's better to choose best in class. So maybe you want to have one software for your dispatch and logistics, and another for your retail, and a third for your lubricant business. And honestly, it's a case-by-case business. It depends how your company is structured, profit centers, how things are integrated or not integrated, and really needs to be looked at in a very holistic way. Because at the end of the day, there is no one software that does everything well. And you know, I don't want to pick on PDI, but you know, it's one of the problems that has happened with their acquisitions is they've acquired stuff but never fully integrated it. Again, I was speaking with a client recently who's using Transpac and Telepoint for dispatch and logistics for tank wagon and transport, and you know, it's still not fully tied into enterprise. There are still things that have to be done twice or have to be done manually. So there is no perfect software out there. Certainly not that does every aspect from retail to wholesale to transport to lubricant. So there are softwares out there that each have different strengths and different weaknesses. And anybody who's using a Factor or a DM2 or an Ascend Firestream or something else that's, you know, either has been or will soon be end of life, you don't only have PDI as a choice. And I'm not saying PDI isn't the right choice. I'm just saying it behooves you, before spending hundreds of thousands of dollars or more to choose a software, look at what your options are that are out there. Make sure that what you're going to choose is the best fit for your company and your specific needs. If nothing else, make PDI sharpen the pencil. Have a couple of other folks come to the table, and A, I guarantee you PDI will sharpen the pencil. And two, you might find some feature functionality in another software that PDI doesn't offer you, and you can speak to them and say, listen, you want our business? We're talking 2 years from now anyway. This is some feature functionality we want to have, and we need you to commit to it in writing. But again, I'm listing out some other software companies here that have different areas of expertise and quality. Ads, I think, is a head-to-head competitor with PDI. iRely has some pluses and minuses. I've got some retail softwares listed next, some wholesale software, some transport software, and there are more options out there. So again, please don't just assume or think you have no choice. There are choices, and it is without a doubt to your benefit to look at some of these other options for a variety of reasons. Preparing for and implementing software. Again, there are a lot of folks, and one of the biggest things that we've seen for our company and growth has been because of PDI's purchases of their competitors. A lot of softwares, again, are being end-of-lifed or soon will be, or are no longer being enhanced or have less support. Again, the Factor users, the Ascend, the DM2 folks. You need to start thinking about making a decision sooner than later. All of the software companies have seen an increase in business. They only have so much bandwidth. I have a client who was recently quoted that the project wouldn't start for 9 to 12 months. So they're probably 2.5 years away from being able to implement a new software. You want to start looking at these things now, figuring out what your needs are, who the appropriate people are to bring to the table, and again, start that process. And we do a lot of work with our clients on creating requests for proposals, managing presentations, and making sure you're getting the best software to fit your needs at the best price possible. After you've chosen a software, and maybe you are choosing to just upgrade with your existing company, whether it's an ads or a PDI or whomever, an upgrade or a move is never quite as simple as it seems. And you need to make sure that you have the bandwidth internally that can do this work. I doubt there are many of you out there that have companies where folks are just sitting around twiddling their thumbs. So making sure that you have people that can devote significant portions of time to doing the software and to doing it properly. Because quite honestly, I think everyone on this call and anyone who's ever implemented a software can tell you the only thing worse than implementing a new software is implementing it poorly. It will cause far more headaches and problems than continuing with a lesser software that you have, or an older software that you have today. So making sure you have the staff to make that happen. And again, I was speaking to someone a few days ago who they've been working on the project for 18 months, they told me, and the biggest hang up has been they had an acquisition and they needed to focus on that. And then they had a key person leave the company and they had to find a replacement. So in the meantime, you know, they've been paying and waiting and holding on, trying to get this new software implemented, and they're going to be over a year, year and a half late in bringing it live, all because of bandwidth. The next is expertise. Many of you have strong IT folks, have people who have implemented software in the past, but making sure that you have folks that understand what the process is, because again, these are decisions in configuration and setup that you're going to want to live with for 5, 10, or 15 years. And it's much easier to invest the time and effort in setting it up correctly now than to find out you want to, you know, unwind it later and make changes to configuration or setting. The other thing is, you know, when you're choosing a new software or you're preparing for or implementing a new software, this is a chance to do things in a different fashion. Again, I'll go back to because we've always done it this way. Look at your chart of accounts. Does it give you the actual reporting and the breakdowns the way you want, or would it, if you added more profit centers or switched things in a different way, would it be beneficial to you? If you got rid of if you have 5,000 accounts that are no longer active, that have just been clogging up the database, getting rid of those. If you've got retail stores and you have 14,000 items, but your stores only carry 3,500 items, don't bring over garbage. Don't redo things exactly the way they are today, unless that really is the best way. Whether it's speaking to your software company, speaking with other members of the study group, using a resource such as ROG, now is the perfect time to take a step back and think about the configuration, the process, the procedures, and really get the most out of your new software. Another thing is timelines. I rarely, in particular, with all the acquisitions that have happened and how the software companies have been bombarded with new customers, we've seen a lot of problems with timelines. And as I've mentioned a few times in this presentation, there's a lot of downside to something dragging on for 2 years, whether it's frustration of staff, turnover, lack of cohesiveness, and so forth. So coming up with a viable timeline, figuring out how you're going to make that happen, again, whether it's with internal resource or external resource, such as a consultant, regardless, you want to make sure that you've got something that's reasonable but isn't going to last forever. One of the things that we've put together with the study group is a offer of a free initial discovery. There are no two companies on this call that are the same, that do things the same way, not even accounting for that matter. So the only way we know if we can be of help to you, or to what degree we can be of help to you, is to have some initial conversation. And we typically, what we do is we offer an initial questionnaire to learn about the business, some follow-up emails and calls to clarify questions, short written report as to the areas that we've identified that we feel we can benefit you, or that you can benefit yourselves with, and then a conference call to follow up. While this is a commitment of anywhere from 3 to 6 hours of time on your part, I can guarantee you that in the last 16 years that we've been doing this, I don't think we've ever had somebody come back and say they didn't gain valuable insight, actionable information, something out of this process. So again, I hope I was semi-coherent today. I do apologize. I've got the flu or something going on, so I'm trying my best here, but I hope what I've said made sense and brought some value to the table.
Well, I appreciate that, Mark, and yeah, I know with COVID floating around and all that, we certainly hope you can get better very soon. But do appreciate you taking the time here. We'll, as well, for the audience, send out Mark's contact information. If you want to follow up with him and any questions on anything he shared, what some of the options are out there in addition to PDI, or, hey, what's the best way to go about trying to explore some of these alternatives? What questions should I be asking? Sometimes we don't know or we don't know. Mark is a good resource for doing that. So again, thank you all for your time here on the call today, and look forward to seeing you next time. Take care.